This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 7 deals with accountancy and the accountancy profession. And we start off simply looking at the very wide influence that the accountancy profession has. And we're just looking here at all the sort of involvements that we have. And there is financial accounting. Financial accounting is really the preparation of the financial statements, which are sent once a year to the shareholders of the company. This tells the shareholders how well the directors, their agents, have looked after the company, have been good stewards of the company. And once a year they have these financial statements arrive and they can make a judgment. Financial accounting is also used on a kind of day-to-day basis. Usually financial accounting is, another meaning of it is really the transaction processing we talked about, the recording of the sales, the purchases, the wages paid and so on. There is audit. Audit is could be external auditors, there's sometimes also internal auditors. But these are people who go in and basically check that the information provided in the financial statements is properly presented, is what sort of is true and fair, does not have what are called material misstatements, or if you like, significant errors in it. Because if there were material misstatements or the information was not fully disclosed, then of course the shareholders are not getting the full story about how their company is doing. Management accounting, this is really an internal function of accountants. This is usually producing, This is usually producing here monthly accounts for the purposes of making managerial decisions. So budgets, variance analyses will see how whether the company's beyond profits, below profits, whether costs are going above, below, and so on. Consulting, accountants very often involved in consulting, maybe advising a company on a takeover, maybe advising a company on a suitable IT system for their accounting system. Tax, very complex in many organizations. It's a function which, unless a company is very, very large, it will probably outsource those accountants because it's very skillful, it changes every year and so on. And it's very difficult for a company to have the resources to keep up to date, unless it's a very large company. Public sector accounting, accounting for how the government spends money, government departments spend money, how government contracts have gone, how maybe local councils have spent money on repairing roads and running schools and so on. There, they can be auditing it, or they can be preparing the reports and financial statements of these government bodies, these public bodies. So a very wide-ranging potential influence of the accountancy profession, and because of that, because many different people will be using these results of our work here, it's important that accountants themselves got very high ethical standards. Really, it's the maintaining of these high ethical standards which help accountants, if you like, to stay in a job. If you didn't have high ethical and professional standards, why would anyone come and pay you good money if you were a kind of dishonest amateur? If you're an honest professional, then it's worth paying you good money. So, we need ethical codes here. And we mentioned here something called IFAC, and this is the International Federation of Accountants. This is a kind of global body that many national accounting bodies kind of belong to, if you like. And IFAC's function is to kind of further the profession, if you like, and also to try to bring together different professional accounting bodies in different countries to try to get them in a way behaving the same way and to the same standards and so on, using the same accounting standards, same auditing standards and the same ethical standards. One of their subcommittees is called IESBA. And IESBA is the International Ethics Standards Board of Accounting. So International Ethics Standards Board of Accounting. And the IESBA issues a code of ethics, for example, which ACCA adheres to, and the ACCA's own code of ethics is entirely congruent with the IESBA one. And basically the point of the code is that there is an acceptance that the accountancy profession has a responsibility to act in the public interest. That because it is reporting to shareholders, maybe reporting to members of the public, and so on, that it has a lot of interface with the public good and the public interest, and it must act ethically and responsibility to fulfill this public interest. It establishes what are called, we'll see, 5 fundamental principles of ethics then. And basically what it says is you have an ethical principle, and that ethical principle may be under attack, it may be under a threat, as they call it. And what we should do is to think about these threats, think about them in advance, because forewarned is forearmed. If you can predict where a threat might arise from, you could maybe avoid the threat altogether, or you have got some way of reducing that threat to what's called an acceptable level. So that's the framework. You've got ethical principles. You anticipate threats which could fight against these ethical principles, and then you, having been aware of the threats, you think of ways in which you can diffuse what these threats might be. And these are the fundamental principles. You have to know these words. You must know these words to talk sensibly about ethics. So what do they mean? Integrity. Integrity is kind of honesty, but it's more than honesty. Integrity is certainly being honest, but it means standing up for what you believe in. It means if, let's say, a client, if you're doing an audit, a client comes along and argues that the financial statements should be shown in a different way, and you're sure they shouldn't be, that you don't just cave in. It means that even if that client threatened to take the audit somewhere else and you lose them as a client, you should stand by your principles. Integrity also means, I think, not turning a blind eye. There are some people, they say, oh, I won't look any more at that, because if I look any more at that, I might find a problem in that. That is not exercising integrity. If you see a bit of a problem, you should really investigate it fully to see whether it's a very limited once-off problem or whether it's endemic and a very serious problem. So it's honesty, it's standing up for what you believe, it's not being frightened to look in case of what you might find. Objectivity is looking, is not having other influences, if you like, affecting your judgment. So it's looking at the facts coldly and reporting the facts as you see them, as they seem to be to you, without perhaps being influenced by conflicts of interest. So examples of integrity in here under the objectivity here. How would it be, for example, if you were auditing a company and your brother was the chief executive officer of the company? To what extent could you be objective? You don't want to get your brother into some sort of trouble. You don't want to, maybe your brother would lose his job if the financial statement showed a poor profit and so on there. So you are going to be influenced by your personal relationship with the brother, and personal relationships are identified as a threat to certainly objectivity and independence. Integrity, standing up for your beliefs. Well, if this was your big brother, and as children, your big brother usually beat you up, and you were kind of frightened of your big brother. To what extent can you exercise integrity? Would you be able to stand up against big brother, even though you're both in your 30s now, and so on? So this familiarity, as it's called, is recognized as a threat, and you should simply avoid getting into those positions. Do not start reporting on a company which is run by your brother, or indeed a close friend of some sort. Similarly, what happens if you get a huge fee from one particular client? You don't want to lose that fee. So again, how can you be independent, objective, show integrity, and so on? And the Code of Ethics say that, for example, you shouldn't get more than 15% of your total fees from any one client. You don't want to lose 15%, but you're going to probably survive okay with that. Professional competence and due care. Accountants are professional. They shouldn't take on work that they are not competent to do. They should spend enough time and effort in doing the work properly. So just because you're qualified as an accountant will not mean that you are in a position to be able to do every job that's asked for you here. Again, you might have qualified in a manufacturing company, and then you go into a bank and so on. To what extent are you going to be able to deal with forward contracts, future contracts, very complex works in a bank and so on? If you were an auditor, have no experience in banking or insurance, and have to audit these organizations, you'd be just taking a complete risk. You couldn't do a good job on that. And again, maybe you should stay away from that work, or make sure that on your audit team, you have somebody who knows about this specialty. Confidentiality. Accountants, whether they're auditors or whether they are employees of a company, have access to extremely confidential information, which is often what's called price sensitive. In other words, if this information got out, the stock price, the share price, would go up or down because of it. So you are preparing, you're employed in a company, you are preparing the financial statements, you see that the profit is coming in is really good this year, and you go and tell your brother about it, and he goes and buys his shares. And then when the profits are released, of course, up goes the share price. That's not allowed. You're privileged to get this information. Similarly, the auditor isn't allowed to release this information, and so on. There is this confidentiality, between a professional relationship there. It gets into some difficulty in some cases. What happens if you discover your client is doing something which is illegal, for example? And we'll probably come across that later on when we get to looking at something called money laundering and so on. So by and large, you need to be careful about even reporting illegal activities. The accountant is not a kind of watchdog of some. The accountant is not a detective. Let's put it like that. Professional behaviour: you must not act in a way which brings the profession into disrepute. So one of the common things that is talked about in this is that you shouldn't say denigrate competitors. You shouldn't say come to us for an audit because the people you have at the moment are no good. Okay, this brings down the reputation of the profession in everybody's eyes. So you must remember integrity, objectivity, professional competence and due care, confidentiality, and then the final one, the professional behaviour not to bring the profession into disrepute. What we have here, just a very short list, nothing terribly important about it, just reiterating how many people use accounting information, and underlining if all these people are using accounting information, how very important it is for accountants to try to get it right. to act properly, to be properly trained, to act ethically and so on. Because if they get things wrong, many, many people are going to be adversely affected by that. Difference between management accounts and financial accounts here. Management accounts are the internal ones here. They can be in any format. They record and analyze costs and revenues, often in considerable detail, revenues from each product, costs of each product, and so on and so forth. They provide information for decision making. They look back at what's happened and they look forward at what's going to happen or what we think is going to happen in terms of budgets. And based on budgets, you will make plans, maybe to increase the production of one product, maybe build a factory to allow that, maybe withdraw another product, change a factory over to making a more successful product, and so on. We'll be looking at cash flows and so on in there. It's internal. Typically, they are produced monthly. As I say, they can be any format whatsoever, and indeed, quite often you get rather non-routine sort of reports coming out of them. They're not always exactly the same format every month. You can ask for special reports. Financial accounts, on the other hand, and we may have that. Oh, yeah, we have that over there. We'll come to the other slide in a moment. Financial accounts, they record financial transactions as they happen, historical financial transactions. You sort that into accounts and so on, and then you can prepare the financial statements. Second slide on it, any format, forward and back, often non-routine ad hoc, not governed by statute at all. A company can produce its management accounts in any format it likes, or if it's really risky, doesn't have to produce them at all. It's not subject to audit, no external checking. There might be internal audit, but certainly no external audit. Here in financial accounting, the format is regulated. It's regulated by law. It's regulated by accounting standards that we have to comply with. They're always looking back, what happened, to last December and so on. They are routine, prepared every year, usually once a year. There are statutory and accounting rules on how they should be prepared and so on. And in most companies, once they get big enough, they're going to be subject to what's called an external audit. External auditors come in, they check that the financial statements seem to be more or less true and fair, if you like, not holding any material misstatements. The main financial systems that we have within an organization. Purchasing and invoicing. So we're thinking of maybe in a functional kind of system here, you have your accounting department. What we're looking at here is how the accounting department, the financial accounting department, the financial system, if you like, is broken down into subsystems, into separate departments. And this is typical of what you have. You have one department that looks after purchasing and invoicing. So when you purchase the goods, from whom do you purchase the goods? What price is reasonable to pay? When do you need them by? How do we know we've received them? How do we know that the invoices coming in are really for goods that we've received? How do we know that the invoice is showing the right price? How do we eventually make sure that our supplier is paid once and once only for the goods they have supplied to us? Payroll is self-evident, usually two sorts of pay. You can have people who are on a salary, so much per month, constant. And then you have quite often hourly paid people who would typically be paid once a week on the basis of hours worked. Credit control and sales. How do you record sales? And also, to whom do you decide you want to make sales? You don't want to make credit sales to people who might never pay, who don't have the money there. So within this here, there's assessing people's credit worthiness, maybe taking up references, making sales to them, recording that they owe you the money, making sure they send you the money, and making sure you know they've paid you and so on. So that's all rolled in there. These people here, this is this is called payables sometimes. The payables ledger is the ledger or the book, which shows to whom you have to pay money. This credit control and sales, this is sometimes referred to as receivables. The receivables ledger is the people from whom you should receive cash. Cash and working capital, managing that. It's important to realize early on in your career that businesses don't go into liquidation because they make losses. They go into liquidation because they can't pay the wages, or they can't pay the rent, or they can't pay the interest to the bank there. Running out of cash is a quick death for businesses. Making losses is a slower, more protracted death, and sometimes it can be reversed here. But looking after your cash and making sure that you have it all planned out. So like you might do with your own personal cash. You know, I have to pay for my holiday then, I know I have to pay my exam entrance fees then, and so on. You balance with what's coming in, and sometimes you postpone certain payments, maybe the purchase of a new television or something, until you know you can actually pay it. You'll be making use in some of this of short-term credit, maybe on a credit card. Companies are exactly the same. They're looking at the cash and looking at the credit they have. The working capital here is basically the capital that kind of changes day by day. And the working capital is you have your inventory, you have your receivables, you have your cash. This is known as your current assets. Then you have things like what I just put one in here, your trade payables. Trade payables is what you owe to your suppliers. I'll put another one in, maybe your overdraft. This is going to give you your current liabilities. So basically, your current assets are either cash or should turn into cash within 12 months. Your current liabilities is amounts that have to be paid potentially within 12 months. What you're kind of depending on as part of your working capital and cash management is really you're using your current assets to pay your current liabilities. This has to be paid in a couple of months. This is going to be available in a couple of months, and you have to make sure there's a kind of flow going on there which is going to enable you to pay it. If you find you have to pay your suppliers, you don't have any cash, this is when things get difficult. And then in some companies, bigger companies, you have a treasury department. A treasury department is, if you like, the super cash department almost here. Treasury will look after, for example, the raising of new cash, new capital. Maybe from a share issue, maybe from arranging bank loans. The Treasury will look after if you have some spare cash, where should we deposit it and for how long. The Treasury will also look after if I'm exporting to another country and I'm going to be paid, let's say, in US dollars. What happens if the dollar exchange rate moves and it weakens? Is there anything I can do to reduce the risk associated with this foreign trade, so that maybe no matter what the exchange rate does, I'm never going to be losing too much, and so on. But you really are quite a big company before you get to Treasury. Okay, most companies, have a cash department here, but then they get really big and really international, particularly if they're quoted companies and are thinking of raising more capital for the markets and so on. That's when the Treasury department becomes really much more important. We've been talking about financial statements. We've been talking a little bit about auditors and so on. Let's just remind ourselves what the external audit does here. So here we have. You can have the auditors, and they will report to the company, to the managers. What the auditors do is they go into a company They examine how the company is recording its financial transactions. They look for errors in those financial transactions. They look where errors could occur in those financial transactions. And what they do, first of all, is they report to the management of the company saying that the way you record your financial transactions perhaps isn't very good in this area, or that there's nobody who is authorizing overtime payments, so there's nothing to stop overtime being paid too much. So they report internally, but probably their major function is to report externally to the members of the company, members as the shareholders of the company, reporting that it is true and fair, that the financial statements basically have no material misstatements in them. And the financial statements is the profit and loss account, or the statement of profit or loss, it would now be called the balance sheet, or it would now be called the statement of financial position, rather than balance sheet. A cash flow statement, showing how the cash moved over the historical period. Supporting notes, which get longer and longer and longer, explaining lots of matters in here, making lots of disclosures that are required to be made, maybe by statute or accounting standards. And the final one we need to put on here is a statement of reserves. Statement of reserves showing how basically the retained profits have changed. This is when the financial statements are talked about. This is what's meant in auditing terms by the financial statements. I'm not going to say very much about these two slides. This is just the regulatory system in the UK. Obviously, nothing beats statute. We have the company law, we have the Companies Act, and so on then. And then we have accounting standards. Accounting standards set out how you should present many of your amounts in the financial statements. This is governed by the Financial Reporting Council in the UK. This will try to get itself in line with what IFAC is, International Federation of Accountants. A subunit, a subcommittee of the FRC is the Accounting Standards Board. And the Accounting Standards Board is the body which is responsible for issuing accounting standards, saying maybe how you should be showing depreciation, or how you should allow to change depreciation, or how you're valuing goodwill, or whatever the other particular problem is. There's a few other little bits and pieces here which you can read about, not maybe as vital as the top two. Other bits of the regulatory system, EU laws can impinge in European Union members here. It states, for example, that listed companies anywhere in the EU must comply with international accounting standards or international financial reporting standards. There is an element or a hope that accounting standards used in different countries can be aligned. And now, instead of financial reporting standards, more and more you see that financial statements are drawn up in line with international accounting standards, and these have been drawn up by the International Accounting Standards Board, and then are usually fairly rapidly taken on board by national accounting bodies and become uniform throughout the many countries in the world. Just know what GAAP is here, generally accepted accounting practice. A set of rules comprising law, accounting standards, stock exchange requirements, and so on, which taken together kind of set out the way financial statements should be drawn up.